Hello and welcome. You're watching Know Your Company on NDTV Profit with me, Somit Sarkar, and my co-anchor Varsha. Well, today the company on our show is Sharda Cropchem. So what are the key questions that we would want the management of Sharda Crop to answer on our show? Firstly, on volume destocking and pricing pressure globally, what are the current trends is something that we would want to know from the management. The second key question would be European market, which is one of the key markets for Sharda Cropchem. Are the headwinds that we have been seeing so far, are they reducing there in this key market is something that we would want to know. And when it comes to margins, they have been quite volatile in the past. But what is the outlook and what is the guidance that the management is giving on the margin front is something we would want to know from the management. And when it comes to tariff, US tariff is something that we have been talking about. The company gets around 20% of its revenue from the Northern America market. So what has been the impact of this tariff and how does the company plan to utilize the high cash balance that it has on its balance sheet is also something that we would want to know from the management today on the show, and we'll try to get an answer to all of that questions in this show. Firstly, let's start off with what does Sharda Cropchem do? Well, Sharda Crop is a crop protection chemical company which is involved in marketing and distribution of wide range of formulation and active ingredients globally. Now, in the agrochemical business, if you look at, the company has a market-wide range of formulation and generic active ingredients. Globally, it sells fungicides, herbicides, insecticides to protect varied types of crops. And when it comes to the non-agrochemical business, it procures conveyor belts, general chemicals, dyes and dye intermediaries from Chinese and Indian manufacturers and supply them to more than 30 countries in Europe, Northern America, Latin America, Australia and Asia. Now if you look here, the segmental mix or the revenue mix of the company, it gets nearly 86% of its revenue from agrochemical business, which is a seasonal business, and 14% of its revenue comes in from non-agrochemical business, which is a non-seasonal business. So this is the revenue breakup that we have currently for Sharda Crop. Apart from that, if you look at, the company has operation in more than 80 countries with an established global marketing and distribution network. There are more than 500 third-party distributors and sales force and the sales force is more than around 400 for the company. Now, if you look at the business model of Sharda Crop, it's quite unique. It's in the crop protection. It involves identifying off-patent generic molecules or those products that are going off-patent very soon. And they apply for this and register them in markets where demand is quite strong. During if you look at during the identification process, it also assesses the margins, the local competitions and the demand that they're expecting from the product going forward. Then they begin the process for registration. Now, it does not involve into any manufacturing and molecule and formulation. All those are procured from other companies from China and India. They just invest in registration of the process, registration of the product, and that's the reason why their business model is quite asset light. Now, if you look at the graphic that was just coming on air before this, we could clearly show you how they are involved, in which regions they are involved. Europe, which I was mentioning, one of the key markets, gets around 62% of the revenue. Latin America, they generate around 6% of the revenue. Northern America, around 30% of the revenue, and from the remaining part of the world they get around 3% of the revenue. Apart from that, if you look at you can also get a product-wise breakup of Sharda Cropchem at this on this graphic plate here. Herbicide product contributes around 50%. Half of the revenue comes in from this product. When it comes to the crop protection mix, insecticides contribute around 24%, and fungicides contribute around 26% of the revenue. Now, as I was mentioning, they have an asset-light business model because they just invest in registering the product. Other than that, there is no much investment that happens in manufacturing or manufacturing the raw material for this product. They outsource everything that is active ingredients and other formulations from other players. So that is what it does, and this what results into is cost competitiveness across the board and across other players as well. And hence, if you look at the margins of Sharda Crop, it is slightly higher compared to its peers. Now, if you look at the outlook, Varsha, can you give us what is broadly the outlook that the management has shared for FY26 and beyond?
Yeah, so outlook is actually very important considering, destocking that we have been seeing and also the headwinds across Europe and, across, I would say, the chemical market or agrochemical market. So on that note, FY26 revenue growth, if I were to talk about, is maintained. So they've maintained their revenue growth guidance of around 15%. We would want to know if this has been inched up considering the Q1, and we are in Q2 as well. On the EBITDA margins, they are expecting EBITDA margins in the range of 15 to 18%. Now, they have increased their gross margin target or guidance, I would say, but they have not increased their EBITDA margin guidance. So, we would want to know if there is a possibility of increase in the EBITDA margins as well for FY26. While the capex guidance, if I were to talk about, so they are expecting almost 400 to 450 crores of capex, mainly towards product registrations, and the gross margins are expected to remain at 35 to 36%. So overall, considering the historical growth that the company has seen because of the pressure in the chemical industry and agrochemical industry as a whole, 15% of revenue growth looks okay, and even the expectation of gross margin improvement is also good when it comes to Sharda Cropchem. But we would want to know whether a company can grow beyond 15% for the next 2 years, and how is the outlook for overall EBITDA margin and gross margin as well.
Well, this gross margin is something that would be important to track, given the fact that there are a lot of movements that we are seeing when it comes to raw material prices, specifically on the API side. But now let's take you through what are the parameters on which we'll be rating the company. First will be the income statement, where we will look at the financials of the company over the past few years, balance sheet, how the balance sheet is there any debt on the books, cash flow, return ratios. These are the first 4 parameters. Then there is shareholding, how the shares have performed in the market over the various time periods that we'll be checking, how the valuations stand for FY26, FY27, and also when compared to its peers, and then what are the analyst view when it comes to Sharda Crop is something that we'll be checking in the show today. And firstly, let's start off with the income statement. Varsha, can you take us through how's the P&L account looking like for Sharda Crop?
Yes, thank you for that. So, if you see, the company has not performed well. Now, this is because of the industry dynamics that the company is going through. If you see the 3-year CAGR return when it comes to revenue, it's just 6%. EBITDA is in negative, while if you see net profit is negative 4% considering 3-year CAGR. Now, one of the reasons, or rather I would say the main reason, is because of the China destocking. The realization of the end product has gone down, and that has affected the revenue overall. If I were to talk about, so in 2024, look at the 2024 number, net profit was just 32 crore, while it has in 25, if you see, net profit is 304 crore. So what happened in 2024 is because of the external challenges that the company faced because of the Ukraine-Russia war, which impacted their foreign exchange gains, number one. Number two, the pricing of the agrochemicals, as I was saying, decreased significantly, which led to the lower profitability in 24, and the excess supply from China contributed the price declines, which I was saying is because of the destocking and all. The end product realization, the end product price was down, and that affected revenue overall. If I were to talk about the Q1 numbers, because in Q1 FY26, the numbers were really good. So if you compare year on year, the growth was 25%, EBITDA growth was 67%. We have seen good improvement in margins as well, and the net profit saw also a huge growth. Now, one of the reasons, if just let's play this margin trajectory, how margin has cope up with it. So in 22 it was 20%. To Q1 FY26, if you see, 14%. So what happened in Q1 FY26 in terms of numbers, if I were to talk about, there was a good growth seen in volume, number one, though there was some pricing pressure seen, but volume growth was really good, which actually impacted positively when it comes to their Q1 numbers. Now, even if you compare margins also in Q1, the margins were really good. Why? Because of the positive foreign exchange, or rather I would say foreign exchange gain that the company has seen. Now, this is one-time impact that we are seeing in the margin. So overall, the Q1 was good mainly on the back of volumes, good volumes that the company has seen. And in overall, if you see in agrochemical market, or rather many of the other agrochemical companies have seen good volume growth in Q1. We would want to know if this volume growth is sustainable, and can we see this volume growth going ahead.
So the key takeaway that is coming in from the income statement for our viewers is the fact that there is a lot of volatility in this business, and hence we are giving it a thumbs down. FY24 to FY25 we can see a big jump, but over a longer period of time there is no growth that the company has reported, and that is largely because of the global issues that we are seeing. Now coming on to the balance sheet part. If you look at the balance sheet of the company, it's quite strong. Borrowings are largely zero. The company has a cash balance of 260 odd crore rupees. But do remember, nothing majorly has changed over the last 3 years. The balance sheet continues to remain without any debt, and the company has not done any major acquisitions. The cash balance has continuously increased, but that is also one reason why the company's return on equity has come down over a longer period of time, because the company has not been utilizing its cash. Whether they will do any big acquisition or not is something that we want to know from the management. Yet, given the fact that there is nothing much change in the balance sheet, we are giving it a neutral rating, just because the company has not done, does not have any debt on the books, hence a neutral rating coming in. Cash balance is 260 crore. The key question here to ask to the management would be, how will they utilize this cash?
Yeah, on to the cash flow statement, Somit. So let's see how that is. So we've given thumbs up because we've seen good operating cash flow, which has increased from 328 crore to 604 crore. Now, if you see in FY25, the net cash flow I'm talking about, why this is positive, because of the payables, positive payables that the company has seen. So basically, they have not made the payment, and this is good in terms of the credit cycle or the credit that the company has earned, and one of the reasons why you're seeing this positive cash flow. So overall, considering the operating cash flow, which is an important metric when it comes to companies, so 604 crore, not bad. Even if you see CFO to PAT at 200%, very good, and net cash flow at 40 crore, not bad considering the expansion that the company is doing. So overall, a good show when it comes to cash flow statement.
So yes, the company has been generating strong cash, and that's the reason the company's cash balance is also on the higher side. A thumbs up coming in for the cash flow segment. But the next ratio that we'll be looking at, or next parameter that we'll be looking at, is return ratios. As I was mentioning, yes, the return ratios have improved from FY24 to FY25 because of the reasons that Varsha was mentioning, at 60-odd%. But over a longer period of time, from FY21, FY22, if you look at the return ratios, 25.7 was the highest return ratio that the company has reported in FY22 at 25.7, and this has come down to 16-odd%. And one of the major reasons behind this, obviously lower profitability is one of the reasons, but also the high cash that has been sitting on the company's book is the reason why the company's return ratio has come down. Return on capital employed has come down to 16% from 25.7%, the peak that we had seen in FY22, and return on equity has come down to 12.8%. from 19.8, the peak that we had seen in FY22. However, we have given this a neutral rating because the company's return ratios have improved over FY24, and it's still quite stable compared to other global peers if we look at. So not that bad of a number, but a neutral rating because it's still below compared to what its peak numbers were in FY22 that we have seen so far for Sharda Crop. But the next ratio that we'll be talking, or the next parameter that we'll be talking about, is shareholding.
So nothing much dramatic here, you know. If you see, promoter holding have not changed since 24, and FII's though stake has increased, which is a good thing. DII stakes though has reduced. So overall, you know, nothing dramatic. I mean, it's FIIs are increasing stake considering the volatile cycle, or rather the pressure that the chemical industry as a whole has seen. But maybe, you know, we don't know, maybe because of the good volume growth overall that the agrochemical has seen, maybe FIIs are interested, and that's the reason you're seeing slowly and steadily they are being increasing their stake. So overall, and the good thing is 74% of stake is with promoters. That's a skin in the game. We would say an investor like this. So overall, yes, a positive when it comes to shareholding pattern.
Let's a thumbs up, 75% promoter holding. FIIs increased despite the fact that FIIs have been seller in the Indian market. We are seeing an increase in the shareholding from 2.4 to 5.5. Thumbs up coming in for shareholding pattern. Now, if you look at how the share prices have performed over various time period, in the last 1 month, it is down around 6.5%. But over a longer period of time, 6 months performance, 67% up, clearly beating the markets. In Nifty was also up around 10 to 12%. This stock has been given a return of 67% in the last 6 months. YTD 10% return on last 1 year, again 64% return is what we have seen coming in from, and in the last 5 years the stock has nearly gained 3 times, 229% return, 3x jump that we have seen in the last 5 years coming in from Sharda Crop. Hence a thumbs up coming in when it comes to street cred.
Now, let's talk about valuation, which is important metric over here. So, if I were to talk about basis FY26 and 27, the valuations are at, 15x and 14x. But considering the peers, like you have Dhanuka Agri, you have, though UPL is a very big company, but Sumitomo and Bayer Crop, considering the peers other companies in, I would say a valuation not bad show here, because clearly considering the peers, the valuations are at discount to their peers. So we won't call it as a premium valuation that the company has seen. Maybe the upside would be more over here. And considering the guidance that the company has seen, if EBITDA margins move upwards, if gross margin move upwards, we may see a good growth, good returns when it comes to Sharda Cropchem. So, but overall, a good play when it comes to valuation, considering the peers. Valuation is at discount. So at 15x for FY26 and 14x for FY27.
Well, a big discount coming in on the valuation front, but this could also be because of the fact that the company's financials have been quite volatile, but a thumbs up coming in given the fact that it is trading at a discount. And lastly, if you look at how analysts are viewing this counter, there are 3 buy ratings, 2 hold ratings, 0 sell, and the return potential is 26, but there are 2 hold ratings given the fact that the financials have been quite volatile. A neutral rating that we are giving when it comes to street coverage. Now that brings to our full rating. If you look at the whole sum up here, income statement thumbs down, shareholding thumbs up, street credit thumbs up, valuation thumbs up, street coverage thumbs up. So I guess the overall rating is coming down to around 5.5 out of it, which is not bad for Sharda Crop. A 5.5 rating, 26% is the return potential that we're expecting from that analysts are expecting from the company over the next 1 year time period. Right. With that, let's welcome in our guest for the show today, V Bubna, the Chairman and Managing Director of Sharda Cropchem. Sir, firstly to start off with, I would want to understand, given the fact that your financials have been quite volatile. Obviously, this is because of multiple reasons globally that we have been seeing when it comes to volume destocking, pricing pressure that we have been seeing. So how are these trends now? Any improvement are we that we are seeing when it comes to these trends that have been continuously hogging the company in the past?
No, sir. Now the company is doing very well. Now I'll make one comment on the valuation that Madam had said. See, the promoters are not doing any buying or selling of the company shares. The last time we did was in March 2020, when COVID had started. China was the first to receive the COVID, and Sharda's business is totally dependent upon China. So the share prices saw a very big beating, and it went down to as low as 99. And on the inside, the company's situation was very good. We were having normal exports, normal transportation, normal shipments. So I said, this is the time to buy. We had only very small room to buy, but I bought about 10, 15 or maybe 20,000 shares in March 99 at 99, March 2000 at the rate of 99. And we are still holding those shares. Since then, the management has not bought a single, promoters has not bought a single share or sold any single shares.
Clearly
Most of the companies,
right.
Yeah.
Right, sir. We clearly understand that the promoter have not sold. In fact, we are highlighting that point that the promoter holding continues to remain quite strong at around 75%. But what we want to understand from you is that volume destocking and pricing pressure have been an issue for Sharda Cropchem of late. But are the trends improving now in the global market?
They are improving certainly, and they are improving very well. What had happened about 2 years back or last year is a thing of the past. Now the global trend is normal. The global inventory levels are also normal, and there's a good match between the consumption and production.
Hello, sir. Varsha this side. Pleasure to have you at NDTV Profit. Sir, just wanted to talk about, have you seen any recovery when it comes to pricing? Now, why I'm asking this question is because typically Q4 is the best quarter for you, but you've seen good growth when it comes to Q1. So, can you sustain this Q1 growth that we have seen going forward in the subsequent quarters as well? Because we are already in Q2. And how has the pricing trends been in Q2? Some on-ground reality if you could share with us.
Madam, your question I'll break in two parts. First of all, the pricing. The pricing are improving. They are not improving as fast as and you would expect. They are improving slowly, but there is a very positive trend in the pricing.
Understood. And
And
please go ahead.
Pardon me?
Sir, my second part of my second question was, you've seen good growth in Q1 because Q4 is typically the best quarter for you, but we have seen good growth in Q1. Can you sustain this growth going forward because you're already in Q2?
We should be able to sustain it. See, our business is also dependent upon the cross-currency exchange rates. Our sourcing is all in dollars. 95 to 97% of our sourcing is from China, and our sales are majority of the sales are in Europe, which is around 40 to 45%, sometimes even more. So the euro-dollar exchange rate has a very critical impact on our performance. In this year, the euro-dollar exchange rate is very stable and very respectable. That is why the performance is good. Now, I cannot say what is going to be the situation between euro and dollar in the next 2 quarters. It all depends on a lot of factors which are beyond our control. Firstly, the Ukraine-Russia war and many things. That is the only thing that is going to impact our business adversely, if at all. Otherwise, we will be able to sustain.
On that note, sir, even that was my follow-up question. The EBITDA margins were fantastic because of the foreign exchange gain that you received. Now, what is the expectation? What is the sustainable margin that you can see? Now, why I'm asking this because you've given a guidance of 15 to 18% of EBITDA margins for FY26, but you have increased the guidance when it comes to gross margin. So, can you see EBITDA margins beyond 18%, say in FY26 or 27?
It could be.
Okay, so
Right. Just wanted to understand one thing, sir. Given the fact that you get at least 35% out of revenue coming in from the Northern America market, any impact that you have seen of the tariffs that have been imposed? Because I remember in the first quarter call, you did mention that dealers are not delaying their purchases at this moment or not buying too much of material because they are expecting the tariffs to get implemented. But any impact that you're seeing after the tariffs have got implemented now?
Sir, I want to tell you, this tariff increase is not going to affect our business at all because our products are not freely tradable. If the customer wants to have a product, they have to be approved by the US government. And the process of approval of US government or registration is very expensive, time consuming, and with a lot of uncertainties. So the customer has no choice but to buy the products from the same source. And the second source to develop will take many years. So we are able to pass on all the tariff increase to our customers, and he in turn is able to also pass it on to his customers. And finally, the citizens of US are going to pay it in the terms of food products.
Right. And last and quick answer from you, sir, on the cash and cash equivalents that you have. Currently, it's around, as of first quarter, it was around 790 odd crore rupees. How are you planning to utilize this? Any acquisitions that you have planned? Do you plan to give higher dividend to shareholders to return the shares that the company has accumulated so far?
See, we do not have any acquisition in mind.
Okay.
To answer your question. As far as dividend is concerned, we have doubled the dividend in the year ending March 25, the last quarter. We could consider increasing the dividend if the other factors are able to support it.
Right, sir. Well, thank you, sir. Thank you for joining us and explaining your company in detail. Well, that was the management of Sharda Crop and all you need to know on the company on the KYC show. Well, with that, it's a wrap on this edition of KYC. Stay tuned and keep watching NDTV Profit.